Amazon is the largest company by revenue in the world and is currently down 55% from all-time highs. The company lost $1 trillion in market cap. Yes, trillion, with a T. In this video, we'll talk about Amazon's earnings, their growth story, and finally we'll look at their financials to come up with a fair value for the stock. First, let's look at their most recent earnings report. The third quarter earnings report caused a massive sell-off for the stock. The headlines were horrible and people were dumping shares left and right. The main headlines of the earnings report were AWS slowing revenue growth and Amazon's seemingly lower operating cash flows. I say seemingly because the headlines mention the trailing 12 months operating cash flow being down about 30%, but that's deceiving because that takes into consideration the previous 3 quarters, which haven't been as good as last year's third quarter trailing 12 months. But if we take a closer look, we can actually see that operating cash flow was up 60% year over year and up 22% quarter over quarter. We can see the pattern of operating cash flow finally start to reverse. We've had 4 quarters of slowing operating cash flow, and now we're finally seeing it tick back up. Overall, the earnings report is showing signs of slowing revenue growth, which is understandable because of a few reasons. One, we are going through an economic slowdown. I mean, GDP has been slowing down for 2 quarters, and this is something we kind of all expected. We did expect earnings to slow down this year. And secondly, something people didn't actually expect, were foreign exchange rates being hit. So Amazon's revenue gets negatively affected from international customers. So think about it, if customers are paying for products in euros, and now the euro is worth less, Amazon has to go and convert that back into USD, and so they lose a bit of money on those transactions. The positives of the earnings report was cash flow margins finally start to tick back up again, which is something that management promised to do. They promised to focus more on profitability and more on cash flows. Okay, so now let's talk about the different segments of Amazon, and which ones I'm most excited for. In their earnings report, they show us their different segments and the revenue growth on each of those segments. First, let's start off with their online store segment, which is their legacy business, right? So Amazon.com, the Amazon we all know and love, that is only up 7% year over year, which isn't too great. Next up is physical stores. So I think physical stores are like their grocery stores and their department stores, and that's up 10% year over year, which also isn't too great, not too bad. Now the next segment is third-party seller services, which is up 18% year over year. So third-party seller services, think of people like you and me selling stuff on Amazon. And the reason I'm so excited for it is, first of all, it's up 18% year over year. And second of all, this is much more profitable for Amazon. They don't actually have to buy stuff and then go out and sell it. They can just offer sellers a platform and skim some profits from both the buyer and the seller. The next segment is subscription services, so this is kind of like Amazon Prime, and that's up 9% year over year, which isn't too bad. Subscription services is definitely a high margin business, so that's good to see. And the next segment, which I'm super excited for, is ad services. So their ad services are Amazon ads and Twitch ads, and those are up 25% year over year. And that's really nice to see, right? So ad services is a very highly profitable business, so it being up 25% is really nice to see. And the last segment, finally, is AWS, and that's up 27% year over year, which is also an incredibly high margin business. So you might look at this and say, okay, so some segments are growing quickly and some segments aren't. But the reason I find this so exciting is because the segments that are growing quickly are the ones with high margins. And that's something I love to see. I think Amazon is now in profit mode, right? So their business plan was to make everyone fall in love with the brand, the online store, get everyone hooked, make sure everyone's a loyal customer, and then start selling them higher margin services. So like the AWS, the ads, and the subscription services. And as someone who worked at Amazon as an operations area manager, I can vouch that Amazon will go through lengths to keep their customers happy. So I think they have a phenomenal business model. Now that we have a better understanding of Amazon's business and their different segments, let's take a look at their numbers. First off, we'll take a look at their balance sheet. Now, if I'm being honest, this is one of the few things I don't love about Amazon. Their debt. They have a total of $290 billion in total liabilities, while only having $130 billion in current assets. Their current ratio is 0.94, which isn't too great. And looking forward, I want to see Amazon start paying down their debt with the cash flow they're generating. Especially with higher interest rates, high debt is not something you want to have. Moving on, let's take a look at Amazon's PE ratio. So this is where investors actually get spooked. Amazon has a PE ratio of about 80, which is incredibly high. But Amazon was never the type of company that would be valued according to their earnings. Their earnings have historically been all over the place, and I think their operating cash flow is the best metric to value them. That being said, let's take a look at their historical price to operating cash flow. We can see that anytime it trades at 20, it represents us with a great buying opportunity. And now we're trading at 21 times price to operating cash flow. Finally, the part we've all been waiting for, the DCF model. We're going to be running a DCF model to determine what price I will be buying Amazon shares. I'm going to be projecting out 5 years, and I'm going to assume a 10% operating cash flow growth, which I believe is pretty conservative. I'm also going to assume a 0.5% share increase and a price to operating cash flow of 20, which, like we saw, it does represent the historical lows. And I'll use a discount rate of 10. And using these figures, we get a fair value of 76. Overall, I think Amazon has one of the strongest businesses out there, and I truly don't see any of their segments getting disrupted. And it's getting really close to my buy target. Thanks for tuning in. Don't forget to like and subscribe. Peace.